All right, so in this video, I'm going to talk a little bit about non-spontaneous liabilities that can be related to current liabilities management. So when you're dealing with non-spontaneous liabilities in the current liabilities area, basically we're looking at a few different categories. One of them would be bank loans. So basically just kind of a standard short-term loan from a bank. Could be 30 days, 60 days, 100 days, 80 days, a year. And those are potentially going to be structured in some different ways. So one way they can be structured is with a fixed rate, so a fixed interest rate over the period. They might also be structured with a floating rate that actually changes with market circumstances. The way that they can be paid can also depend a little bit on how they're structured. So some of the loans may have interest due at maturity, so you pay interest at the end of the loan. Another way that the loans could be structured would be interest paid in advance, which are considered to be discount loans. Now, one of the things to kind of keep in mind with those would be if you're looking at those two, if I borrow $1,000 with say 5% due in a year, if it's interest due at maturity, I'm going to pay the 5% at the end of the year, and I borrowed the $1,000 during the year. If is an interest paid in advance loan, a discount loan, basically what's going to be calculated there is the amount of interest that has to be paid that you pay up front. And so if you think about it, you sort of, I'm borrowing 1,000, but then I have to pay interest up front, which means I'm not actually going to borrow the full 1,000 for the full period. And so if it is structured as a discount loan, you'd have to make sure that you're borrowing a high enough loan amount such that you walk out the door from the bank with the amount of money you actually need for whatever reason you were borrowing the money. Because you are going to pay interest in advance, and so that's going to affect how much money you have on hand right now. And there are some single payment notes that are associated with bank loans as well, or basically is maybe a short-term loan, a well-established business where you're borrowing money for a very specific purpose, and then you make like one payment at the end to pay it off. You can also have lines of credit, which are generally arrangements with financial institutions. And so in that case, basically they're sort of pre-approved you to basically take out money without having to go through a full like loan arrangement at the time because you're kind of pre-approved. And sometimes as a condition for that would be a compensating balance. They require you keep a certain amount of money maybe on deposit in the bank. And ultimately, one of the effects of that compensating balance is because it ties up some of your capital and it has to stay in that financial institution. The reality is it tends to increase your realistic cost associated with that loan. So your economic cost of the loan tends to be a bit higher than the rate that's quoted because that money has to stay on deposit. Now, significantly, sometimes these lines of credit specify that there are operating change restrictions, meaning that if anything really significant changes with your business's operations, then that sort of established and approved line of credit may no longer be valid. And the reason why that's worth noting is sometimes people may be sort of tempted to kind of think, well, I've got plenty of liquidity. I've got this line of credit sitting over here, but the bank said that they'll extend me $1 million whenever I need it. Well, the problem with that is if you enter into a bad economic situation such that your financial situation changes rather dramatically and you're going to need that liquidity, well, that may well trigger that operating change restriction. And now they may pull that line of credit. You don't have a line of credit anymore. And so now you don't have the liquidity you thought. So one of the things that I have long emphasized to people is a line of credit is not liquidity. Okay, so a line of credit may be the ability to borrow at the moment, given current circumstances, but that does not actually equate to liquidity in the true sense, because right when you might need that liquidity is quite possibly, if we're dealing with a bad economic circumstance that kind of intervened, if you really desperately needed it, there's a chance that something may go on there with that operating change restriction that may have triggered the possible removal of that line of credit. So it's not a great practice to kind of count on a line of credit as being something that will be available to see you through a difficult time, because that might be exactly when they remove it. So liquidity is liquidity. The ability to borrow, not the same thing as liquidity. A revolving credit agreement basically takes this idea of a line of credit and essentially takes it further. And the basic idea behind the revolving credit agreement is kind of a situation where you're kind of sort of borrowing and then paying it off as money comes in, and then borrowing and paying it off as money comes in, and borrowing and paying it off as money comes in. And so you're sort of constantly borrowing and paying off, hence why it's considered a revolving credit agreement. And so in that case, it's sort of an ongoing arrangement. But it's worth noting again that that is something that if you're counting on that ability to borrow, there is the possibility that if circumstances change enough, that revolving credit agreement could be pulled at some point, depending on what the contractual terms might be and things like that. There is a possibility there, and so you need to be very mindful of that. Another form of non-spontaneous liabilities would be commercial paper, and this is basically a short-term unsecured promissory note that is sold on a discount basis. And so what that means is investors might pay, say, $990, or let's say they pay $950, say $950 today to the company, and they receive $1,000 back at the end, and that's how they get their interest because they paid $950, they get $1,000 back. Basically, it's roughly a 5% return there. That's how they're kind of getting their return on that security. So they aren't paying interest payments. It's just sold on a discount basis. Overall. And so these are issued to investors, oftentimes below prime rate. And so companies can kind of view that as a way to raise short-term funds at a somewhat advantageous interest rate. There have been some market circumstances in which basically investors kind of back away from commercial paper, and there have been some businesses that were funding a significant portion of their short-term needs with commercial paper because it looked attractive, and then the market for them kind of dried up because all the investors panicked due to market circumstances, and it led to a situation in which all of a sudden, some companies were scrambling trying to figure out, well, how am I going to meet this funding need when this commercial paper is coming due in 90 days, and nobody wants to buy more commercial paper because of economic circumstances. So you do have to be a little bit kind of careful with that. There are also some international loans that can be linked in some cases to trade and things like that. This can have some additional wrinkles associated with it because it might involve a different currency, for instance. But there are some international loan situations that might facilitate ongoing trade and things like that between countries and so forth. There are also secured short-term loans provided by commercial banks. So this would be a commercial bank, but it's secured by something. So it basically is a form of collateral here specifically. So it could be something like basically using inventories. So using inventories as the security or the collateral for the loan. And there can be limits and parameters for how that's executed. One other possible way is pledging accounts receivable. So using accounts receivable as sort of the backstop for the short-term loan. In a related concept to that is actually factoring. Factoring is basically when a company has a bunch of accounts receivable and they don't want to wait to try to collect it. They need the money now. So they sell the accounts receivable to somebody else at a discount, basically to collect money right now. Well, that's similar to the idea of borrowing with accounts receivable as the collateral. You're kind of trying to cash in on those accounts receivable faster, and that's a similar notion there. But all of these are examples of non-spontaneous liabilities that could be used to essentially fund some of those current assets and things like that. But what's the difference between these non-spontaneous liabilities and these spontaneous liabilities is for the non-spontaneous liabilities, there's somebody somewhere who has to make the decision to loan you the money, right? So in the case of a bank, some loan officer or officers somewhere are making a decision. Same thing for lines of credit. We got some loan officer somewhere is making a decision. Commercial paper, investors somewhere are making a decision to loan money. So commercial banks, international institutions, whatever. Basically, there's always somebody that has to sign on the proverbial dotted line to actually loan you the money. And so the difference there is they do not arrive spontaneously. They don't happen just from me running the business. I'm going to have to go appeal to somebody, whether it's an investor, a loan officer, somebody, and convince them, make the case that they should lend me the money. They may not, right? They may not decide to do so for whatever reason. So it is not a guarantee that they're going to do so, or they may offer terms that I don't like, right? In the case of spontaneous liabilities, those were liabilities that arose pretty much automatically just from running the business. I don't have to get approval from a loan officer to make that happen. So that's kind of the distinction here. The non-spontaneous liabilities, there are some people somewhere that could decide to say, no, they don't want to lend the money. And so as a result, you have to be a little bit thoughtful about that if you're relying on the non-spontaneous liabilities. If they're all coming due within a short period of time, if a bunch of loan officers decide they don't want to lend you more money, hopefully you have enough liquidity to pay those off and to continue on running your business. Hopefully this video has been helpful. Thank you so much for watching and have a great day.